Well, welcome everybody. We're here, Glasgow COP26. Thanks so much for joining us today, for those people in the audience and indeed for those people joining us online. We are live streaming globally for this event, so thank you for joining us. This isn't a virtual background, we are really here, finally. So, my name is Matthew Reddy, I'm the Senior Private Sector Specialist with the GEF, the Global Environment Facility, and it's my pleasure today to introduce our panel of participants who will be discussing the theme of private finance for sustainable landscapes to meet net zero goals. So first of all, I'd like to introduce who's joining us in the virtual format, Ingo Poole, who is the co-founder of South Pole and representing the Landscapes Resilience Fund for this particular session. Next, we have Stephen D'Onofrio, who is the Director for Ecosystem Marketplace. I think everybody knows Forest Trends and Ecosystems Marketplace for their reports on voluntary carbon markets, invaluable resource. And then we have joining us also virtually Kevin Rabinovich, who sits on the Private Sector Advisory Group with the Global Environment Facility and is the Vice President for Sustainability at Mars, but also representing the Livelihoods Fund, so an important role there. We'll also be joined today live by Florian Kemmerich, who is the Managing Partner of Bamboo Capital. And last, but by no means least, of course, we have Jenny Henman joining us from Clar Mondial. So our panelists here today. So about this session, what can we expect from this session? So we all know that to meet the 1.5-degree Paris targets, we must dedicate levels of funding that are commensurate with the ambition that we have for transformative change in the AFOLU sector, agriculture, forestry, other land uses. And we have a huge gap. People might have heard Prince Charles this week talking about the gap in finance and that the private sector is ready to step up to meet this challenge and help close this gap through a variety of approaches and different funding sources. And we're going to explore that in the sessions today. But we have a sense of urgency here. We must do that now. And we must work together and we must work differently. But the business models and the investment case for landscape initiatives for mitigation and adaptation, let's be clear on that, are not widely understood by investors or indeed by many actors in the private sector. The challenges represented by climate risks, the longer return on capital, and of course, not just land tenure, but all tenure, carbon tenure, tree tenure, water tenure, make challenges for scale of investments. So we need innovative and context-specific financial mechanisms, not just to fill the gap, but to get the level of transformative action that's needed for this sector. So I'd like to open with some first remarks, please, from Ingo Poole from South Pole. Over to you, Ingo. No, we have a no-go Ingo, so pardon me for that. Well, we'd like then to turn to Stephen D'Onofrio, the Director for Ecosystem Marketplace. Stephen.
Hello, everybody. It's great to be here today. Man, how many of us did not think this conference would actually happen in person? It's incredible to be here. Thank you so much for the GEF and GCF for putting this session together and for inviting me and for inviting Ecosystem Marketplace and Supply Chain. So I will not try to replace what Ingo would have done as a scene setter landscape of landscapes, but I've been working in and out of carbon markets, voluntary carbon markets for about 16 years. I've been working in the forest risk commodity space for the past 7 years, corporate disclosure and transparency for this entire time. And I'll offer some reflections in a moment about where the markets for voluntary carbon are going, and as well as forest risk commodities and things that we're doing. But just to set a little bit of the context for me personally and for the voluntary market, 10 or so years ago when I had left the voluntary carbon market space, this was after the Chicago Climate Exchange, after the United States decided not to put together a federal plan where all the pre-compliance work could have fallen into. What pursued forward was corporates taking corporate sustainability very seriously. Obviously, we're dealing with the fact that we need to move faster. So much more needs to be done and scaled. But we have, I guess, been privileged by the fact that in the United States, despite a federal policy that is still yet to actually come together and very likely, unfortunately, even with the Biden administration, is going to have its challenges, that the private sector is moving forward. And I'll talk about what we're doing in supply chains to monitor that and map out how they're dealing with forest risk commodities. On the other side of it is the way that we've tracked voluntary carbon markets over the last 16 years. So the ecosystem marketplace has become a little bit of a very small sort of David and the Goliaths of the storyline of those types of organizations and companies that track markets, that track finance and prices of traded carbon. We've been doing this for 16 years. In the last year, have completely changed the way we do things because the market's moving faster. We're not seeing daily liquidity, but we're now seeing the need for more than annual data, which is a huge kind of milestone. I think, for a voluntary carbon market to finally be at a point where the annual reports that we were doing aren't good enough, that was actually a good thing. So that pushes us to then say, well, how fast do we need to produce this? So we've developed a new system that's daily capable, but is not really watching the market on a daily basis because the trading isn't happening that much on a daily basis. But we are set up more in a monthly and quarterly updating process. So we will be releasing some new results of the state of the voluntary market during COP at some point. We have a number of organizations reporting new trades. But last month, or just over last month, now September 15th, we launched a new report that showed that the voluntary carbon market is now on track to hitting $1 billion for the first time ever in a given calendar year. So $1 billion is still very small when you compare it to hard commodities like oil or any mining, commodities. But in terms of environmental markets, this is huge. So it presents a lot of challenges, a lot of opportunities as well as challenges. But the challenges are companies getting it right when they're saying that they're going net zero or carbon neutral? And will, if they don't get it right, impact people's understanding of the quality and credibility of carbon markets, of carbon credits? Because they're two very different things. One's evaluating integrity of projects and whether they're able to deliver benefits to the ground, develop benefits that are to climate, develop benefits to ecosystems and biodiversity. Whereas the other is about whether or not a company understands how to develop a corporate sustainability strategy that is aligned with best principles of net zero and carbon neutrality, which those definitions still are yet to really be conclusive. So as we are trying now to bring together these two worlds of companies that are dealing with forest risk commodities and trying to tackle the problem, the source of the problem, which is the need for land and the need for growing agricultural products or for grazing cattle or whatever the use is, are those companies actually developing net zero goals? So in addition to zero deforestation, do they have net zero goals? And then of those, how many of them are investing in carbon offsets as a way of rounding out their approach towards getting to a net zero future? And so I have some new research, which is why I have to pull up my phone because the team has just sent it over to me. And I'll read this off, so it's a bit open to some adjustment as we do some more cleaning. But we, as a part of we were funded initially through the Global Environment Facility, GEF 5, GEF 6. We've now received some additional funding and support through various partners, the Accountability Framework Initiative and Ceres, as well as NICFI. And as a part of this, we've kind of taken a little bit more of a narrow approach. For right now, because we have about 1,000 companies that we track for their forest risk commodities commitments, zero deforestation. we narrowed that down to about 150 publicly held companies that are very impactful, that we know have high exposure to these commodities at different points of the supply chain. And we found that of those 150 roughly companies, and I'll just pull up the numbers here, about 87%, 128, had a deforestation commitment for one of the 5 commodities of palm, pulp and timber, cattle, soy, and cocoa. Now, the next step for our work is not just to see if they have one commitment for one of these commodities that they have exposure to, but they need to have commitments for all, or how are they setting the materiality process of determining which in sequence should they tackle. In terms of a GHG target, so 150 companies roughly, 97 had a time-bound GHG reduction target. So that's 67%. And I would say not nearly enough. If you have a forest risk commodity target and you don't have a GHG reduction target, and we're not having this conversation in the same place. You might be focusing on biodiversity, on livelihoods, and smallholders, on other reasons for tackling deforestation, but climate change is a huge component of that, and that should be a part of these. Then when we take those 150 or so companies, we see that only 37 roughly have a net zero or carbon neutrality goal. So 37 companies of the 150 have a carbon neutrality or net zero goal. And these are significant companies, and I can list off some names later. Of those that have those types of commitments, 22 have said that they're purchasing offsets as a means to getting towards their net zero or carbon neutrality goal. We shouldn't be arguing about the fact that some companies are doing this, but the majority are not. You know, the majority of companies are not using carbon offsets. The majority of companies actually may be using offsets in some cases, but don't want to say that they are, because the moment they do, there's criticisms. So what I think need to better understand is what are the elements that companies need to have in place in order to then open the conversation up for offsets, because 22 of these companies, you know, that being the minimum, is very low, because we know the true benefits from these projects. And, you know, I'm sure Ingo would have talked about this. And then I have a couple of just final things here. When we think about those 22 companies and we look at what they've stated, the things that we've looked for, if they're saying they're purchasing offsets, what standard are those credits from? Is it Verra, Gold Standard, any of the reputable standards? Is there are there any time-bound elements related to the vintages? So are they purchasing vintages from back in 2012 or 2008, 2019? Are they developing spot or future contracts because they're trying to plan for 15 years in the future? Or they're trying to offset historical emissions and current emissions? All these specifics, which I think we would find to be pretty necessary to truly evaluate those net zero goals if they're purchasing carbon offsets, are very, very sparse. There's very few additional details about what is behind the fact that they say that they are purchasing credits for their net zero goals. So this is what we need to try to help companies with, because this will unlock finance. It doesn't need to hold it back. We need to support companies to understand what are the pieces that they need to describe in their corporate sustainability strategies around net zero if carbon offsets are going to have a strong place there. Otherwise, it could be a very detrimental situation if we just criticize without asking these questions and supporting them to be more transparent. So we're all about transparency, all about data, all about trying to find out what's actually empirical, not what is sentiment-based. And hopefully, we have some questions. I'm happy to answer them as we go through. Thanks.
Thank you, Stephen. And I think people will be most keen to read this findings from this fascinating report. And no doubt you'll be sharing that during the course of COP26. Now, you mentioned companies with forest risk commodities, and you mentioned companies with net zero targets. That brings us nicely to our next speaker, who is Kevin Rabinovich from Mars, a company that indeed has forest risk commodities and, again, is a company with a net zero target. Kevin, we would like to ask you, joining us in from Zoom, how is Mars responding to these challenges of landscape finance, and in particular, Mars and other partners' investments with the livelihoods venture? And what solutions have you deployed? Thank you, Kevin.
Last-minute credentialing challenges didn't quite make it into the blue zone to be there in person. So I'm in a hotel room here in Glasgow, zooming in, but I'll be in the blue zone tomorrow. Yeah, I think, you know, I really, maybe I'll start off by echoing a number of the points that Stephen just made, which is, you know, I think really one of the big keys to unlocking, you know, prevention of deforestation and preservation of landscapes more broadly is this connection to carbon accounting. You know, so many companies have made commitments to greenhouse gas goals, and you know, Stephen talked about those sort of 150 big players, but you know, the number of companies that are making SBTI or now potentially SBTI net zero commitments has exploded, and really linking the carbon measurements of landscapes and of, you know, our supply chains and things that we source out of those supply chains into those targets is critically important, because that's, you know, gives the idea of protecting forests or protecting landscapes. It moves it out of sort of the qualitative realm into the quantitative realm, where you can really start putting hard numbers to things and writing business cases and comparing one investment against another, and letting business frankly do all the things that we're good at. And so, you know, we've been at Mars have been doing greenhouse gas accounting for land use change associated with our supply chain for 6 years now. So that's been part of our scope 3 accounting and part of the targets that we set in 2017 and then updated this year with a shift to net zero for our full value chain, all scope 3, nothing left out. And that really is critical to helping drive the change here, because what we very quickly discovered was that greenhouse gas emissions from land use change were a significant part of our footprint, but happen in a relatively small number of commodities in a relatively small number of places compared to everything that we buy all over the world. And that makes them incredibly compelling from a carbon mitigation strategy point of view, because you can get a lot of bang for your buck, as it were, in terms of driving carbon reduction, which, you know, if you care about forests and you care about landscapes, that's an awesome outcome. For someone to look at the problem you're trying to solve and go, ooh, that helps me fix a problem I want to fix too. And so, you know, therefore, that's where I want to put my time and energy and investments. And, you know, I think maybe I'll say one more thing before talking about the Livelihoods Fund, which is clearly the place this discussion needs to start for every company is in its value chain, and in their sourcing. You know, if we are buying commodities in a way that incents or even indirectly motivates continued clearance of forests, you know, we shouldn't be celebrating investments that we're making outside of our value chain if we're still doing the wrong things inside of our value chain. You know, that's really critical, is needing to address both sides of this. And so for us, you know, that's part of our commitments. The other thing that we've done, which goes a little beyond the carbon space, is we also have a target to hold the land use in hectares of our value chain flat over time. So we both stop direct deforestation and conversion of landscapes by policies, and then we reduce indirect pressure by not allowing our agricultural footprint to continue to expand over time. However, all of that done, we still know that's not going to get us to net zero. You know, agriculture is not going to get to zero from an emissions point of view. There will be residual emissions, which means we will need to get involved in the offset market through carbon credits. In the case of Mars, we've chosen to focus on removal-based credits, and that creates the opportunity to sync up some of what we're trying to do in our supply chains with the opportunity in many of those landscapes to do restoration, and perhaps in some places even put back some of what we've lost, which delivers benefits at the local level, and then at a global level can deliver carbon attributes to us that help us get to those net zero, or perhaps in the shorter term for some brands, carbon neutral objectives. And that's where something like the Livelihoods Fund comes in. And I think, interestingly, both the Livelihoods Fund and even some of the supply chain activities that companies like Mars and others do recognize that, you know, we're engaging with a system, right? You know, we're not just buying palm oil. We're buying palm oil from a community that has lots of other things going on, other crops, economic well-being, economic development. Livelihoods Fund isn't just generating carbon credits. They're engaging in projects that create livelihoods. And so, one of the sort of signature projects of the portfolio of work that Livelihoods has done, and I won't talk through all of it. Certainly, Livelihoods funds, if you look on the website, you can get more detail. But an example of a sort of project would be, mangrove restoration, where clearly, there's a carbon opportunity from planting mangroves and they pull down carbon. But they're also doing it in places where those mangroves create habitat for fisheries, which create income and food security for local populations that are in those coastal communities. They also create storm protection. So when there are typhoons and the like, the mangroves play an important role in helping protect the infrastructure in those communities. And so you get, carbon may be the thing that's helping bring the finance to it, but the benefits are broader. And so I think that's really, really part of it. And I think, maybe to tie this back in a little bit to the GEF, I think some of the work that we have done as Mars and others with GEF on things like the Good Growth Partnership really lean into this idea of, we're moving away from a commodity era. Right? In the commodity area, you just cared about what you were buying. You didn't necessarily care about the process that produced it or maybe even the place that it came from. As long as the right thing showed up at your factory, you were happy. And those days are gone. And as soon as you start to care about the process and the place, you immediately become more engaged in the landscape. And we think that's going to be much more of what the future is going to bring. And so things like the Good Growth Partnership and I should mention GEF is, alongside Mars and other companies, also an investor in the Livelihoods Carbon Fund. And so I think, that gives a little bit of a sense of the landscape, building on some of Stephen's comments. And so with that, maybe I'll throw it back to you, Matthew.
Thank you very much indeed, Kevin, for sharing those insights from a major global brand and the innovations that you're deploying in not just net zero, but I'm also hearing this emphasis on adaptation, resilience, and equity, which is great to hear. Next, we're going to look at the investor perspective. So what do we really think about when it comes to making the case for a business investment in landscapes? So I'd like to ask Florian Kimminish, who's from Bamboo Capital. How is Bamboo Capital responding to the challenges of landscape finance? And what are the solutions that you're deploying, please, Florian?
Yes, first of all, thank you for inviting me here, Jeff, and also the Green Climate Fund. Specifically, maybe just to explain a little bit. So Bamboo Capital, it's not that we invest in bamboo, but we are doing classical impact investing. So we do for-profit investments where we measure based on a theory of change, what's happening on the ground. Our specialty, we've been doing that now for close to 15 years. And we run also funds, and they have evolved over time. We do private equity and private debt. Strategic partner of us is Palladium Group. And Palladium, of course, runs major development programs on the ground. And this is also where we have pivoted more and more into nature-based solutions and the interest to invest there. But where we start from is looking at the rural population. And with the rural population, we have been typically investing in access to money, microfinance, going also into the missing middle, access to energy, access to healthcare, access to education. And then when it comes to the productivity in these places is mostly smallholder farming. So when we start from that and you see what's happening on the ground and how to finance actually MSMEs over time to bring them investment ready. So we have been between the aid place of a lot of philanthropic and grant money to be supported. We exclusively look at emerging markets, Africa, Asia, and Latin America. And also we have been looking at the role of private money and how to bring private money to invest into, where of course the risk-reward scenario is always a problem. And then we have seen, of course, recently also the role of technology coming in, where technology actually addresses the price point and the access of goods and services for the same population. And that has now where we have pivoted really into partnerships at a large scale. So we run a fund, for example, with the International Fund for Agricultural Development, IFAD, which is Agribusiness Capital Fund. It's focused on the missing middle finance, and again, smaller farming is a big topic in there. Also, with our partnership with Palladium, we've looked into more and more nature-based solutions, as I said before. So it's the land use and the origin of why deforestation is actually happening, and what can be made to mitigate that in a profitable way. So, like I said before, here from Mars, the corporations, of course, is one of the pieces. Like Stephen, you were saying before, climate change has a factor, but then it's a lot also the livelihood of the population. And if you look at the livelihood, sometimes, very often, they're forced to basically take off from the land forests in order to make a living. So you see different angles where we look at actually now from a deal sourcing perspective, where can we invest and how can we invest? Because if you look at how a company is actually, being taken forward, is you have different stages of the company. You have the early stage company, then you have there's a venture, if you want to say that, early stage, late stage, and then you go up, to, really on the larger ones up to also infrastructure plays. And very often it's not very easy how to place that capital, because the capital is also divided by asset classes. So debt is debt, equity is equity, and infrastructure is infrastructure. So that's how the mainstream financial markets actually think. So now the problem is, how do you bring the different players who could benefit jointly into one in alignment and to actually have and trigger a change on the ground? Profitably, but also looking at the theory of change. And therefore, it's not just forest itself or reforest we're looking at the livelihoods, we're looking at the ecosystem systemic plays. How can we place money? And that's where actually the interaction of aid money, of NGOs, of local players, of governments, but also of corporations, SMEs, and then on the larger scale, also if you want to say that from multilaterals, is if you align into what we call blended finance mechanisms, you fill that spot between the pure aid and the for-profit world, where the for-profit world would see a problem. But also we see clear trends, and they're very positive trends. One big trend, of course, is the push and the demand on the consumer side for sustainable, for organic products when it comes to agriculture, for example. And that benefits actually those conversations to look at how can we support and invest in companies to helping them to become more sustainable. And actually not, resolving the problem by scaling through using more land, and taking the forest away, but actually looking at the landscape and how to reshape it. So those are the things where we look at from a deal flow perspective, because it's tough to get the deal flow from a profitable point of view. And we like to focus more on the ticket sizes from an investment perspective. We typically start as of 200,000, and go up to 2 million, maybe sometimes 5 million. And the normal institutional investors, this is way too small for them. So the way we set up these funds, this is a bottom-up approach. So we start with a fund, a blended finance fund, where we have a catalytic first loss capital. And that is basically grant or aid money in there, which is primarily there not only to take the risk, but to protect senior tranches. Then you have senior investors, and you can even go, as you scale, to tap into mainstream financial markets. We are not yet there. We have several of those vehicles, but in the same sense here specifically, where we are extremely excited about, and that's also, I appreciate the invitation, is to talk about the Amazon. Just if you look at the Amazon, only 2% of all the aggregated investments go really on the land sector. It's a very small component. You have 16 million people just in Brazil living there, and very often, if they would stop deforesting, we put their life at threat. So you see, there is no clear answer, but we can see the trends which are pushing for sustainability, the willingness of actually different parties to collaborate on blended finance mechanisms to align the interest and actually being able to kick off companies off the ground from a TA perspective support to make them, tackling a system to make them investable, then to invest at a riskier scale with blended finance funds, and then the later stage to have more mainstream financial market and investors coming in.
Thank you very much indeed, Florian, for highlighting some of those points and the importance of the investors and blended finance. We're going to look again at some of the innovative approaches to getting scale from investors, and it's a pleasure to introduce now Jenny Henman from Clare Mondiale. And Jenny, can you tell us what Clare Mondiale is doing and what are the solutions that you're deploying and the people with whom you're deploying them?
Yeah, absolutely. Matthew, thanks so much for inviting us to be here. It's a real pleasure to speak about Clare Mondiale's work. Clare Mondiale is an investment advisory company. We've been going for about 10 years. It's headquartered in Switzerland, but we've got on-the-ground representation in Côte d'Ivoire, Kenya, and Costa Rica. I myself am based in London, and I work particularly on nature-based solutions, carbon finance, and the smallholder angle. So Clare Mondiale, maybe a bit more of a general introduction, and then I'm going to focus in a bit more on the Food Securities Fund, which we've developed, and the GEF has co-invested in. But Clare Mondiale, more broadly, is actively originating, structuring, and executing investments in the landscape finance space. That includes directly working with DFIs, working on green bonds, and also in blended finance. Before I come back to the Food Securities Fund, we're also working with partners on a really exciting new landscape investment structure for long-term financing in the landscape and for restoration. So can't talk too much about that right now, but might be announcements coming out about that later during the COP, so watch that space. So to come back to the Food Securities Fund, which Clare Mondiale has developed. So that's leveraging the working capital gap, particularly for SMEs in the agricultural value chain. And as I mentioned, GEF supports that. Thank you very much for that, through a non-grant investment. And yeah, I would like to maybe just give you a bit of sort of flesh on the bone of an example of a kind of loan that, an example of one of the loans we're executing. So the loan values tend to be in the 1 to 5 million range. An example would be one that we have made to an East African coffee company who works in the supply chain. They work with around 4,000 smallholders, and they've been going for 2 decades. They've got a really strong track record. But just to try and illustrate a little bit more about what our loan does and the working capital gap, is that there's a real sort of seasonality in their access to finance. And what our loan can provide is earlier season working capital. So that allows them, in this case, to work with more smallholders to get them certified in organic coffee. And with the certification, that means that these farmers can get a much higher premium for their coffee, up to 50 to 100% more. So the loan is enabling that to bring far more smallholders into that certified scheme. And also it's allowing the company to aggregate sooner. So that means that they can have financing for pre-processing. And that ultimately allows them to pay the smallholders much sooner by allowing that aggregation and access to that. So that makes a huge difference in terms of payments coming through to the smallholders, potentially up to 6 months earlier, which you can imagine on the ground is quite impactful. The loan also means that the company gets some of its capital freed up. So although it has access to bank loans and other traditional sort of trade finance it would get on sale of product, the finance we're giving means that they don't then have to use that for the activities I described. So it means that they've got more money to invest in diversification of livelihoods with smallholders, and also things like agroforestry and so forth. So hopefully that's given a bit of a sort of meat on the bone for an example of the kind of investments we're doing with the fund. I don't know if I should have said more about the fund at the beginning. It is an evergreen structure. Obviously, can't discuss details in too much because of confidentiality around that and regulatory rules. Maybe just to wrap up, what we're seeing is a really increase in appetite by investors. And there's a huge demand for capital, but it can be hard to deploy it. And yeah, excited to discuss that a bit more on this panel today and some of the solutions for that.
Thank you very much indeed, Jenny, and indeed that will be the next part of this discussion, is getting really into how do we address those particular challenges. So I'm hearing a couple of things here. Stephen mentioned that the rate of the investment in markets for landscapes and carbon is at an unprecedented level. We're hearing that there's innovation in solutions by addressing this missing middle, this particular area where we're not talking about $10 million, but we're talking about $100,000. And then we're talking about working capital, the types of finance that are accessible to smallholders to really make the changes that are needed. And we're hearing that these investments are also coming from major brands like Mars to invest in their own supply chains and not externally into third-party types of investments that perhaps don't even are relevant to their own landscapes. So I see all of these things coming quite nicely together, and I think that this opportunity for landscape investment will be something that will be explored further as we progress through these next 2 weeks. Now, I'd like to introduce our next virtual speaker, Ingo Pool from South Pole. Ingo, perhaps you might like to reflect on what you've heard and perhaps what I've summarised and what South Pole is in fact doing with its own landscapes funds. Thank you. Can you join us, Ingo?
Yes, thank you very much. I'm sorry for being a little bit late. I want to come back to a statement that I would have made earlier had I been on time. Which is, if you look at the landscape, of course, it's an upstream intervention to reduce pressure related to sustainability on landscape and to increase coordination. But when we look at the larger, one step back, we also have midstream and downstream factors that I just want to kind of like refer to quickly. So if we look at basically the planet is 30% land. 70% of that is habitable, which is about 100 million square kilometers. Of that, 50% is used for agriculture. That's about 50 million square kilometers of land. Of that, 71% is used for livestock-related agriculture, and which is about 35 million square kilometers of land. So if you look at all of that together, I think a very good proxy is to feed a human, we need about 2,500 square meters of land currently. And then if we look at the agricultural system today, it generates about $0.4 trillion of revenue every year. It is subsidized to the tune of $500 billion, subsidies that are not aligned with sustainability often, but that favor like extensive agriculture, put high subsidies, subsidize the cost of, for example, meat consumption. So that's 500 billion in subsidies that goes into agriculture every year. That compares to $180 billion in fossil fuel subsidies, which kind of like dwarfs, towers over fossil fuel subsidies. So that's, I think, just some important metrics. So now, if you look at the potential for reducing pressure on land, if you look upstream, we have now a substantial drive towards more plant-based, downstream, plant-based diets. Just a rough figure, if we introduce, and then the market projections say that this will happen, our plant-based diets constitute about 10% of the global diet. That would basically relieve pressure on land by about 400 square meters per person. If we also consider the fact that we are midstream, that 30 to 40% of all food is wasted, if we have that in the next decade, that would reduce the pressure on another 400 square meters of land, so bringing basically down the need to feed a human down to 1,600 square meter. And then we have landscapes, and the introduction of landscape-based approaches, increasing productivity while driving sustainability, can happen at a rate of 1.5% a year. So that's 15% over the decade, reducing the pressure on another 400 square meters of land. So all of that taken together would mean that we could feed humans, all of them on 1,200 square meters of land every year. And on the question of basically the big funding, like where's the money coming from? This is all I'm still on the macro dimension. Of course, we have this huge opportunity to reduce subsidies or to redirect subsidies into more sustainable use. I think that is a very worthy agenda. And then, of course, we have carbon finance. So in our initial analysis suggests that if, and this is just another very top-down big figure, if 100% of agricultural practices were based more on a regenerative agricultural, sustainable landscape integrated model, that alone would take care of the entire carbon footprint. We could use this to fund the transformation to the tune of $500 billion as well, right? So carbon finance is a powerful instrument that can work at the required scale to make a big change. No? Of course, we are starting small. So in our fund, we now have a total commitment of $25 million US. No? But I believe that is a feasible size to deliver a meaningful proof of concept. And then basically, to the extent that we can demonstrate a strong bottom line in that, make it easy for us to scale up or for others to imitate this kind of model on a strong carbon finance platform. Again, and I think important here is to look at the entire stream of action in landscapes itself, in the topic of food waste, and in the promotion of diet change, and new products that are plant-based.
Thank you very much. Thank you very much, Ingo, for sharing those important facts for us and addressing the challenge also on the consumer and the demand side. So for the benefit of people in the audience and for those that are joining us on the live stream today, our panel today, we've just heard from Ingo Poole, is the co-founder of South Pole. We're joined by Stephen Donofrio, who is the Director of Ecosystem Marketplace and Supply Chain Initiatives with Forest Trends. We were joined by Kevin Rabinovich, who's the VP for Sustainability at Mars, representing the Livelihoods Fund. Florian Kimmerich, who is the Managing Partner of Bamboo Capital, has joined us, and Jenny Henman from Clar Mondial. So these are our panellists here today. Now, I would like to then move to our next question for all panellists, which is really on considering the role of non-private sector actors. So organisations like the GEF, like the GCF, like NGOs, like CSOs. Let's consider, what can be the role of non-private sector actors to really help drive investment in the landscapes. Perhaps we could start with you, Stephen, on this particular question.
Sure. I think there we go. Yeah, I mean, the data that I shared just a moment ago was mostly looking at the private sector and what type of corporate ambition there is versus market-based approaches. So, these are, there's different opportunities here. So what we saw with renewable energy as a market-based mechanism was that eventually now renewable energy as an offset project is really only eligible for new projects in emerging economies, LDCs. And that's because we've been able to transition, the private sector has invested to be able to transition renewables to be, more economical. If we can do that for other climate solutions through market-based approaches, then that allows governments to kind of work on corresponding policies to implement incentives and other approaches. In terms of the supply chains and the commodities that Kevin's talking about, that we cover in supply chain and track on how companies are addressing deforestation that way. you know, these are voluntary approaches. I don't think we believe at all that this can be done without government policy ultimately. You know, we're talking about either illegal or legal deforestation, and voluntary versus, you know, mandatory commitments. They have to be happening together. There's always going to be a scope outside of compliance or regulation. But the issues that you talked about with smallholders and livelihoods is a really important one. We can't ignore that if there are no other options, then the forests are going to be cut down. So it cannot be solved, you know, solely by the private sector, and I would just say it has to be in coordination. Yeah.
Thank you, Stephen. And perhaps we could ask Kevin Rabinovich at Mars. You know, what do you see, Kevin, in terms of the role of governments, the NGO and CSO, perhaps even the research community, in facilitating some of these landscape finance opportunities?
Yeah, I guess I'll start with the governments, and I'll pick up on the point Stephen just made, which is it's very hard to imagine this working other than in a occasional anecdotal way, unless you've got proper land use planning going on. You know, I think we've all visited cities where there is a active, long-standing zoning process, where you end up with sort of a well-organized cities where you've got the right things in the right places and it's sort of convenient. And we've all been to cities that have just sort of organically grown, where there is no overall governing sort of zoning approach to things, and it's much more chaotic. And the exact same thing is going to be true in a larger landscape once you get outside of an urban setting. And really that can only be done by governments. You know, from local governments all the way up to national governments, wherever you are. You need that land use planning. You know, that's really the only way to solve this at scale, which doesn't preclude you from doing a good job here and there on a case-by-case basis. But that, you know, to the math that Ingo is doing, you know, that's not what we need. We don't need this getting fixed case by case. We need a systemic transformation. So I think that's really the key role. I think the role of the private sector in that example is to, you know, engage in our procurement, and to the extent that we are, our investment activities, in ways that make it easier for governments to do good land use planning and help reinforce, you know, the things that we would all like to see them doing, and not behave in ways that, you know, create perverse incentives or undermine, you know, good land use planning. For the NGO community, I think, you know, really the way this space has largely played out is that if I can call them sort of the technocratic environmental and I guess also social NGOs have essentially become the voluntary standard setters, and some of those voluntary standards are quite powerful. I mean, you know, the greenhouse gas protocol is nearly universally adopted by anyone in the private sector that's doing greenhouse gas accounting, does it according to the greenhouse gas protocol. There's no actual reason we have to. I mean, it is voluntary, but we all follow it because it makes sense and it's been well developed and it's been well thought through. And so I think that's an important role for the NGO community, is to help sort of define the rules. You know, which I think does two things. One, it undercuts or undermines the risk of greenwashing, where you maybe have you know, less properly motivated actors that want to do something small and claim it's big. And maybe more importantly, I think it also lowers the barrier to entry for new companies to get involved in this. You know, when there's a favorable regulatory environment, when the rules are clear, when you know what you're going to be able to say based on what you've done and what you can count and what you can't count, you know, when all that ambiguity goes away, this becomes, you know, just a procurement decision or an investment decision for a business, and businesses know how to make that, right? What they don't know how to deal with is some of the uncertainty and ambiguity in the space. You know, not every organization is going to be able to have, you know, full-time dedicated people like myself and my team to you know, figure out the ins and outs of this. And so to the extent that we can make it more routine and standardized, that'll do incredible things to expand the scope of this work.
Thank you very much indeed, Kevin. And I think, you know, this role of the NGO in terms of their technical capacity and working on the ground to support standards, I think is one that we've really tried to foster within the GEF as well. The role of Indigenous peoples, as we've heard this morning, the CSO communities, as people know, the GEF has CSO network, and of course our NGO partners. I think the things that I'm hearing around land use planning, I think that was a very clear point. We made that in the opening remarks about the need for not just land tenure, but carbon tenure, water tenure, and tree tenure, and of course how that is then interplays in the landscape. Regulatory approaches that can then facilitate private sector investment. And one that's come up also in the other Rio Convention, which is of course the Convention on Biological Diversity, the CBD. And if we look at the post-2020 framework, this call for redirecting subsidies or the reduction of harmful subsidies. So to make sure that if subsidies exist, they incentivise and accelerate the right things rather than facilitate the wrong things. And we need to have some policy coherence there. From the investor perspective then, Florian, what do you see as the role of perhaps the non-private sector, whether that be government or NGOs, in really helping to facilitate landscape finance and building scale?
Yes, very relevant comments. And you can look at it from a different part. So maybe from the historical side, we have seen sometimes that grant money or philanthropic money has distorted actually markets. Where from a private perspective, when you invest in, you want to create and support entrepreneurs and their businesses, not necessarily have, any support of companies being given, where later on, they cannot create the scale, they don't have the rigorous, leadership of an entrepreneur. So that's one part. So I would rather say that type of capital should be very wisely be incentivized in alignment to kick companies off the ground, to help them to scale. So therefore, the role of grant money, for example, coming from the governments or from the NGOs, is great to be used, for example, in accelerators programs, venture philanthropy. So really to help prepare to support the educational side of entrepreneurs to get them ready so that actually investors can kick in. I think another component is also, and we see that, for example, we actually have a fund together with Smart Africa, which is in lines in Africa, 31 African states, to want to create a single digital market. And they had the same things. They said also, another component you talked about is regulations. So you have to have a legal framework where an investor can invest in a country, in a safe way in a company, and also understands I invest now and I exit. How can I exit? And this comes down to the currencies, how to can invest a foreign currency, then in a local one and get it out. That we have quite some difficulties in the past, of investments, or sometimes we were asked to go through some other jurisdictions, like Mauritius, in order to invest in Africa. That's also something which is hindering because you have the sublayers. Another component also is to understand that the role of grant giving and philanthropic can be the catalytic part of, as I said before, from a technical assistance point of view to get the company's investment ready. But then also you can use that money to seed blended finance funds, where you make sure that there's no mission drift. You make sure that we're addressing the missing middle finance, not the easy one, the large tickets, but really the, that's a 200,000 to 2 million gap, which is very often a problem because local banks do not lend those companies, specifically not in agriculture, and not even talking about forests. That's a big stretch. And then, thereby, and we've seen that actually, that governments, even African governments like Cote d'Ivoire, has seeded one of our funds with catalytic capital. And then, of course, immediately had wealthy agent like Luxembourg coming in and saying, we want to match this. And now we're getting other investors on the senior tranche on top because the risk reward is reduced. So we can do these investments. But there, for example, NGOs have a great value to look at are we really doing and spending the money we want to on the small tickets? You know, and so you have to have, you know, the impact frameworks we have, where we look at exactly outcome and output, and we measure that. Shouldn't be only looked at us looking them, but also from an outside perspective to monitor. And then the blended finance funds we have very often have a TA pocket aside, which is not managed by us as an asset manager. It is managed by NGOs or other organizations. So for example, GEF in the same way, you talk about the expertise having on forests and the team on the ground. That's something where actually makes it for us easier to invest, because our investment is safer, because you have people on the ground who can help in making sure that certain things are done in a company in order to invest safely, whether it's debt or equity. So those are the parts when you look at, and then you actually, with the risk-reward reduction of a catalytic tranche, and that's one of the funds we're trying to raise right now, is specifically for the Amazon, is for the forestry. It's not the forestry, but it's really the livelihood of the population in and around rainforest and the forest itself, you know, to source deals and to invest in, and we need catalytic capital in order to do so, because pure private, it's just too risky for them, and we would not be able to, you know, have a higher reward, because it's just not feasible, because we're looking at how investable they are. And last but not least, I have to say, is the timeline, patient capital. You cannot go very quick in and out and have a certain yield. You need to be more patient. You have to give the company more time to use that capital, whether it's working capital, whether it's trade financing components to it, whether it's certain things in terms of production, how they produce, what their supply chain is. You know, there are many aspects to it, where I believe the beauty of non-for-profit capital with private capital in these mechanisms, where we're not reinventing the wheel here. We're using well-proven individual elements, just assembling them in a new way. And that's where I think the beauty lies, on really to have a sustained, long-term, investable approach in these geographies.
Thank you, Florian, for those insights. And I think when we listen to this conversation around timing and patient capital, it's not, as you know, not like developing an energy project where, you know, you get a PPA in place and revenue starts flowing with the first invoice. I mean, these are longer term, higher risk investments, and they do need de-risking and appropriate rewards. Perhaps, Jenny, you might be able to shed some light on, from the Club Mondial perspective, what do you think is the role of non-private finance and non-private actors that can support these kinds of investments?
Yeah, thanks, Matthew. So I think we can come at that from a few different perspectives. I think particularly talking to the smallholder angle, obviously huge percentage of landscapes are inhabited and managed by smallholders. So a really important role of NGOs is to help aggregate the smallholders into more organized structures that could actually receive private sector finance. So we see that as a hugely important element, because otherwise there is no way for them to access finance. And that is the actual reality on the ground, that many of them are not organized. So at the moment, often finance is going to the more organized cooperatives and so on, which is inevitable and good. And you know, often for them, they're not getting enough of the capital they need. But I think a huge role for nonprofits is to help actually bring together smallholders who are not currently organized. I think then within that, there's really a role for government as well in terms of helping smallholders access climate finance, because without recognized land rights and clear title, then they simply can't enter into these carbon finance arrangements. And that needs to be like accelerating in pace rapidly. Otherwise, smallholders are going to yet again miss out on investment in a space that really, you know, is looking to invest with them. I think also that the nonprofit world can be really important in trying to ensure transparency and equity in the climate finance space. So at Climate Mondial, we're working with a consumer-facing goods company to help with their offset in setting strategy. And we do find there's not so much transparency between the different actors in the carbon finance, sort of chain. And I think a very important role is for nonprofits to continue putting pressure on transparency over benefit sharing and how much direct payments are actually going on the ground, and making sure that we're all clear on that. We often find it is really not clear with projects that Club Mondial's been doing due diligence on. People simply can't answer that question. They're like, yeah, there's some good benefit sharing. But, how much? Like, what is enough? So I think the nonprofit sector can really help set some limits and definitions there so we can have greater transparency and ensure equity.
Some great points there, Jenny. And perhaps, Ingo, if you're still with us on the virtual stream, could you perhaps share your thoughts on the role of other actors that are non-private sector that can really help facilitate the kinds of catalytic finance we've been talking about today?
Yeah, I think, this is just trying to add to what has been said already. I would just like to maybe also mention the role of labeling and product labeling. I think the fair trade community or the organic certified community has been very influential in really supporting the communities that adopt better practices. And I think this could be the same in sustainable landscapes. The other is, of course, incentives always work. So if we manage to streamline the procedures by which even small projects can have access to carbon markets and monetization, I could see that as very beneficial. And maybe just to come back to what I've said before, I also think that NGOs with government, in partnership with governments, can work to make agricultural subsidies smarter and reward sustainability more.
Thank you, Ingo. That's something that we're hearing, I believe, loud and clear, isn't it? This role of the NGOs to support organising and creating the scale at the project and the pipeline level that indeed is investable. Now, I'm looking at the audience. I can't see who is on the virtual audience, but just a quick show of hands, just so people on the panel can get an idea. Hands up, which continent you are from. So if you are based in Europe, raise your hand. Okay, African continent. Oh, okay, so we have a very large African contingent here today, and highly relevant for this discussion. Southeast Asia? One. Oceania, Australia, New Zealand? Which is probably the market with perhaps the most developed landscape investments, and they're not here. And then, of course, Latin America. Okay, well, we've been talking a little bit about the Amazon, and of course, extremely important for us in the GEF Cerrado biome as well, and those soy-producing communities. North America. Okay, good participation from North America, and then Central and South Asia. No. Okay, so that's quite a gap, isn't it? Anyone from Antarctica? No.
Matthew, this is Kevin. Can I make one more follow-up comment to that last question?
You're from Antarctica?
No. I wanted to make one more follow-up comment to that last question. So I think we all answered, in the role of non-private sector actors, kind of on the capital stack side of the investment, or maybe the enabling environment for being able to make those capital investments. But I think equally important is the revenue side of these investments, right? So someone's investing money, someone's doing something to generate revenue that's going to pay those investors back. And I think, there's an important role for non-private sector actors, particularly governments, again, on that side of the ledger. And I'll give a specific example of one of the livelihoods projects, which is it was a dairy project in Kenya. And clearly there's some carbon attributes, there's some livelihood benefits that come out of that. But one of the other benefits is its manure management and of those dairies helps improve water quality going into Lake Victoria. And there are policy frameworks in place from the government to help with credits, financial credits for eliminating some of that pollution. And so it becomes a way, if you're the carbon investor, that's exciting because that's helping defer or defray some of the costs of those credits, because the carbon doesn't have to carry the entire P&L of the investment. If you're the government, it's compelling because you've now got someone that's putting money into a project that you don't have to subsidize entirely on the water quality benefits. And so I think there's an opportunity for governments to play an active financial role through other policy incentives they have that maybe aren't about carbon or landscapes, but are about other things that are important to their countries or their communities. And sort of, the same way we talk about building a capital stack to invest in the project, building that revenue stack to support the project is equally important. I think that's an important role for governments to play as well.
Thank you, Kevin. Now, I'm looking at the audience, and we have COVID protocols that mean I can't pass you the microphone and hand it to you. So if you have a question, you might like to write that question down. You can just write it on a mobile phone and show me the question, and I can read that question. You can write that question down, and I can read that question. And then if you would like to suggest perhaps to whom on the panel you would like to direct that question, we can do that. So please, if you would like to ask a question, quickly just text one down, and I can make sure that we read and direct that to relevant people on the panel. So I'm going to, whilst you're doing that, I will just like to ask the panel a couple of questions here. And the first one here is to Stephen, having heard about, payments for ecosystem services, the values of these payments. We're hearing a lot about this market development, and you're seeing this rapid acceleration. What key actions from a policy level? We're here at the COP26. What's one policy that could come out of COP26 that would really support market deepening and market development?
Well, I'll take it from two angles, and one of them isn't necessarily COP26 because we've just formalized a partnership between Ecosystem Marketplace and ICAO, International Civil Aviation Organization, to track the CORSIA eligible, the carbon offset scheme for international aviation, which is a compliance sector-based approach to track the eligible credits and the transactions, the prices, the volumes, and the market size, because of the implications that this ultimately has, not just for product developers, to ensuring that we know not only what is eligible, but then what's transacting. How can we maybe segment that out from the broader market, but also to help country governments understand the costs of compliance with international civil aviation requirements. So, this is just starting really, but what it kind of links back to in the question before is the intersection between what has historically been voluntary markets, which are really now, voluntary markets is more about voluntary use, and independent credits coming from standards that those standard credits can be used for voluntary or compliance programs. And that's really the hybrid between these two worlds that we're seeing happen a lot. But can I just say from an Article 6 Paris Agreement perspective, companies and the whole voluntary and compliance market system, really needs the clarity about Article 6. What we'll do, how can companies claim through net zero, carbon neutral, their goals when they're purchasing offsets? How can they claim those credits if there isn't, this clarity yet about how the countries where those credits are originating from can also be, assuming, ownership over, or the ability for those countries to claim reductions associated with the carbon credits and the products that they're coming from. So that, I think, from a carbon market perspective, is probably the most critical piece that we need to come out of Glasgow.
Yeah, very, very good. And I think I like the way you said it's a hybrid approach, isn't it? It's sort of pre-compliance, compliance thinking, from some of the key sectors. Thank you for sharing that thought. My next question, so if you do have questions on those phones, and write them down. If you have a question, just raise your hand and then we can come and collect those. Our Latin American colleague has a question that's coming over. Whilst he's passing that to me, I would actually like to ask Jenny. We'll break up the flow here a little bit. And Jenny, what are the initiatives in landscapes that you would like to see flourish? What are some of the things that you think, this is what this audience really needs to focus on? What do you want to see, and where do we need this investment?
Yeah, well, COP Mondial, we'd obviously really love to see our food securities fund flourish. We'd like to see it attract more investors and to successfully grow our assets there. Just to go back to this working capital gap that we mentioned before, which the fund is addressing, it's a huge gap. Pre-COVID, it was estimated at $1.55 trillion. And so that's like a funding gap in working capital for emerging market SMEs. So it's an area which needs more funding to go into it. And something that we see is that when we talk to potential investors and so on, they say, oh, well, we're investing in the ABC fund. But what we would like to see is, all these initiatives growing and for much more money to flow into this sector and to have a number of strategies going at the same time so we can really be growing as a sector. So, we really encourage that. Also, there are obviously more sort of household names that are in this space, like Goldman's, BlackRock, and so on. But we would just really encourage institutional investors to also be looking to put their money into these more boutique strategies, like the one that we're developing and other colleagues here today. And because there is a need for really specific, experienced expertise in this sector. So we believe that some of the more boutique strategies that are being developed also offer huge promise.
Very good. So that's something we're hearing more. Some of these smaller, boutique, highly targeted strategies are the ones that we should be seeking for landscape finance. We have a question from the gentleman in the audience. This is a question that I'm going to pose to either Florian, to Kevin, to Ingo, or indeed to Jenny. And what are the conditions, what are the investment conditions that investors and the insurance sector, we haven't mentioned the insurance sector, but again, especially for adaptation and resilience, thank you for bringing up that important sector of finance. So what do investors in the insurance sectors need to make attractive? What's attractive for them to restore the balance of carbon emissions and removals in tropical countries? So I will open that question to anybody who would like to respond. Florian, you're nodding.
Yes, and it's a great question, by the way, because one of the problems we've seen, again, it's related to the previous also comments you made, Jenny, for example. So far, to do real impact on the ground, you need small tickets, but hundreds of thousands of small tickets, okay? And you shouldn't slice the population or the world into geographies or into countries or into SDGs, yeah, because you cannot. You need systemic change. So in that same sense, in order to have that institutional money, insurances, pension funds, the fund of funds, the big ones, placing their money, you have a huge liquidity in the market, and it's not trickling down to the small SMEs, or the SMEs in the emerging market. Why? Because the risk is too high and the reward would be too low. So if there is ask, and that relates me also back, Matt, to your question, is there one ask? We are here at COP26, which is UN steered, led, under UN leadership, not a country, not a geography, not a sector, not, a asset class. If there would be a possibility to aggregate these different boutique, streams to tap into mainstream markets, to have the bonds on top of those, And then you can be sure that the green bond is really green, not green-washed. Yeah, and you can also ensure that, you can have, insurances on top. To insure these, to make them non-recourse, to make them mainstream investable assets. And then in a basically organized way, then you could probably, with a reasonable amount of money, it's a large size, but nothing compared to the overall financial markets, to really trigger the change. And if that is then steered on the theory of change, on the land, the use of land, the livelihood of people, and the avoid the deforestation and climate mitigation alleviation, including carbon credits, it's going to be all part of the system, you can create and trigger change.
Thanks, Warren. Any other questions from the floor? Yes, we have a lady here. Okay, I'll read this question, but first of all, I'm going to ask Kevin if you're still on the line, because we really want to take advantage of having a big brand, present here. And, Ingo mentioned before the role of labelling and talking to consumers and demand shifts. So when it comes to the actual consumers of Mars products, what do they tell you? What do they say? This is important to us. And, does Mars sort of lead the consumer in a certain way, or do you respond to what the consumers are telling you, Kevin?
Yeah, it's sort of a wishy-washy answer, but a little bit of both. I think we can to some extent lead the consumers, but I think really the most successful brands, tap into things that consumers want, be they products or services or experiences, and find ways to address that need. And I think there is a need or a desire from consumers to buy more sustainable products and services, more generally, whether that's recycled plastic or deforestation free or whatever it might be. I think that the challenge is that the way we measure all those things with carbon footprinting and things like that isn't maybe the right way to tell consumers the story. It's a very quantitative, technocratic. I'm an engineer by background, so I love it. but in many cases, that's not actually the way to motivate consumer behavior. And I think collectively, we haven't quite cracked the magic to sort of get at what would be described as the latent need, that consumers have there, and that, throwing the 397th eco label and throwing a carbon footprint number at them doesn't seem to be the answer. And so I think that's a huge opportunity and a huge prize for whoever figures out how to start cracking that opportunity. Which is not to say that there isn't segments of consumers today that will be motivated and will change their behaviors on that basis. But if, again, I'll sort of come back to something I said earlier, if what we're looking for is not a tiny niche becoming a small niche of demand for sustainable products or deforestation-free products or carbon-neutral products or whatever, but we're looking for a system-level transformation where that becomes the norm. I think we haven't, as a sort of consumer products industry, as branded industry, haven't quite figured that out yet.
Yeah, thank you very much indeed, Kevin. I think, companies like Mars and those other investors in the Livelihoods Carbon Fund, many of whom are consumer-facing, very conscious about such issues as integrity, and as we've discussed here on the panel today. We have a question from a lady in the audience from Scotland who's working in the Scottish natural environment, and it's around the question of valuation, the valuation of ecosystems, the valuation of natural capital. I would like to ask the panel here, what measures could we adopt, or are you adopting, to actually say this is what nature is not what the nature's worth, but the ecosystem services that nature is providing, that can be valued and assessed. What thoughts do you have about assessments and pricing of natural capital? Open question, so hands up for anyone.
So pricing is a very important topic for any investor. You want to come in at a price so that you can make money. Yeah, shouldn't be too high. Then, of course, the big question, and also ethical one, should water have a price? Should forests have a price? Should air have a price? The question is, twofold. Now, the reality is we all, if we want to foster livelihood, we need to invest in service companies to get into that. So one of the pieces we're looking at, for example, we're investing heavily in access to energy, off-grid energy. And the beauty of the off-grid energy is now with technology, the price point is very low. You're not paying for the energy. You're only paying for the access to the energy because it's rooftop solar, battery stored, and you have the gateway to the internet. And that is life-changing for the livelihood and access, economic access for rural population. That brings back now, how do we treat nature? Because right now you can go to the Amazon and you can buy land and it's pretty cheap, forest. Rainforest. It should stay rainforest, or it should be maybe 20% due to timber and the rest you leave because you have a balance and you only cut as much as you can ensure that's growing, over a longer period of time. So from an acquisition point, it's actually pretty cheap. But then the question is the business model, and the scale of the company and how you can scale. And again, back to smallholder farming, how much you can aggregate, and not aggregate where the smallholder farmer is pushed to cut more trees in order to have more lands to make more money, because it's not necessarily. And by the way, waste management is a big, big, big topic there, even for smaller farmers. Huge in Africa, for example, a huge amount of produce ending up somewhere not valued and not paid for. So again, it's not a straightforward answer, but usually price is defined by demand. And of course, the problem very often is not that there is no market, but the problem is the efficiency and the quality of the companies to actually do and have a price at a price point a population can pay in rural areas, in emerging markets, but then also for the benefit of a food supply, food security, and beyond.
That's a very nice note, Florian, upon which we can finalise this discussion. We've enjoyed speaking about landscapes with you all. Thank you to the audience for their particular questions today. And I think what we've learned is there are a myriad of innovations from scale solutions that are really trying to address this challenge of landscape investment, and that it's up to organisations and NGOs, organisations indeed like the GEF, to be able to facilitate these through better technical assistance and supporting action on the ground. And I think at this point, thank you to those people who have joined through the live stream. If you have comments, please send those through and we'll do our best to address those. Many of the things that we've heard today around blended finance, around subsidies, policy coherence, and the role of the private sector are key elements of the GEF 8 programming directions, which are in draft. So if you want to see how the GEF is responding to these questions, please, I would encourage you to look at the GEF 8 programming directions and what we intend to do in the coming period, 2022 to 2026. Please, for those people in the audience, could we thank those people who joined us virtually and our panellists today?
Thank you as well.
And I wish you all a wonderful COP. Thank you.
Thank you. Bye-bye.